have an opportunity to invest in your fund, but also be able to acquire apartment complex in the same stroke. I had a lot of opportunities to join into real estate, and I guess my younger self did not. But I came to a point where I just said, you know what, there has to be more. I think you provided a good amount of detail, and I love the approach.
Deal will produce cash flow. It'll pay you and your investors. You guys will all make money, and it'll be a cash flowing asset that has, reasonably low leverage, and you'll sail off into the sunset. Cool, man.
Okay. Hey, how you doing?
How are you?
I
See
am
ya.
doing well. A lot of information over the last 2 days.
Yeah, it is a lot. You're right.
Oh yeah.
But I promised people, I'm like, yo, this isn't going to be some like goody two shoes high level where you don't give you any weeds.
Well, yeah, definitely. Very informative. A lot of notes. So, it's just, I guess it's just a matter of practicing what is practicing and putting what you said into action more so than anything else, right? And not just hearing it one time, but repeat, rinse and repeat, and continue to do it. Yeah.
Yeah, and getting over some of those mental hurdles, a lot of times too, and depending on, where people are at, in their journey.
Yeah.
For me to kind of jump and take that leap, tragedy in life. And I don't know if you were here yesterday, I was kind of explaining that, in 2018, I had this moment where, yeah, I had a tragedy where I'd lost a loved one, my sister and the family. And, obviously puts perspective on life very quickly. Belief systems like, am I doing everything I should be doing? Right? Am I stepping up? Because one of my greatest fears is honestly being 80 years old, sitting on my deathbed, having to have a conversation with my 40-year-old self and telling that 40-year-old self, I'm sorry, man. I'm sorry I didn't go for it.
Yeah.
I'm sorry I was too chicken shit. Right. And I just
Yeah.
sat here, analysis paralysis, not making it happen. Right. That honest to God, like scares the crap out of me. So, that is part of the pain that will drive you. So that drove me at that moment to say, screw it. I'm booking my ticket. And I booked it
Yeah.
out to Boston, completely across the country, went to that conference, spent
Yes.
the money, dialed into it. And it was a life changer for me because
I
that's
can
what triggered
imagine.
it for me to then jump in and, get my own mentorship and dive in and look for the first deals and get across the finish line and start making this journey. Then now I look at it, I go, shoot, dude, we went from one condo in 2010, took us 8 years to get to 20 units, right? I'm
eight
thinking about
years.
this. 8 years to get to 20 units. It took us
Mm-hmm.
3 years to get to 1,000.
3 years to get to 1,000 units. That
2018, we had 20 units. 3 years later, 1,000. And the only way that
that
happens is by syndicating apartments and scaling.
that I don't know. So I heard you talk about the fund that you have. So if and how does that work? If we wanted to, I think a lot of times it's all about diversifying. And so if we end up having an opportunity to invest in your fund, but also be able to acquire, apartment complex in the same stroke.
Yeah.
I guess the question is, what are requirements to join your fund, and then find out how we can kind of leverage both aspects of the wheel.
Yeah. And we do both too, right? Because that's how
Hmm.
we scale our money. So we own 6 different mobile home parks, but we have that a little more passively because we're invested in a mobile home park with our friends to do that. So we do the same thing, and I recommend that. It's like you said, it's playing the game of active and passive, and maybe doing a little bit of both if that's something up your alley. So yeah, you can absolutely do that. Nothing against it. We do it now, and we actively run things because we can, and then we also passively invest into certain asset classes where maybe it's not our forte, but we have people that we can do that with. So I would recommend the same thing, so yeah, and we can send out, stuff on like the fund and stuff. I don't try and pitch that stuff. But yeah,
Hmm.
happy to do that. For ours, it's a $50,000 minimum investment to come into the fund. Projected returns are 18 to 22% a year. And the reason we do that, it's a 9 to 12% preferred return. And then it averages out around 18 to 22% a year. The reason that happens is because it's a hybrid, right? We have 25% of the money going into the flips, 75% of the money going into the multifamily game. So when we blend those together, that's how you're able to get those returns. Yeah.
Gotcha. Gotcha.
Yeah. So it's kind of blending risk too, right? So we're not
Hmm.
risking into the flips too much, 25%, but it's giving us the velocity. And then you come into the multifamily, most of the money's going there, which is where you get tax benefits, long-term cash flow, all that stuff. So that's how we designed it, and that's how it's gone.
Gotcha. Okay.
Yeah.
Yeah, I actually, it's funny because I had a lot of opportunities to join into real estate, and I guess my younger self did not, right? And I'm from Illinois.
You look pretty young, my man. You do not look old. So I don't know how old
Yeah,
you are, but you look pretty good.
this gray hair is from teenagers, so that's um but basically, I had a lot of opportunity um, during the time in Chicago, actually, and really didn't take advantage of it. I think one of our friends' father was into real estate, and he was kind of leveraging us for us buy in a very predominant area, but it wasn't predominant at that particular time. Where buy houses, hold on to it, and let developers come and buy it, and then possibly develop some right? Into, massive single family homes. And
Mhm.
so, just kind of my journey is I've gone through the whole aspect of investing in stocks and of course, cryptocurrency, et cetera, et cetera. But I came to a point where I just said, you know what, there has to be more, right? There has to be more because I think, there's a lot of volatile things in the market. And I think you want to find something that's a little bit more stable, stabilized, and that can be passed on as well. Passed on, to the kids, but also be able to teach them how to manage and how to leverage it, when you're gone, you know?
Yeah, and it's all part of that puzzle. So I guess you touched on something important there. Like you had your chance, right, back when, and you didn't take it, right?
Mm-hmm.
And here you are, midlife, and you got another chance. Because here's the cool thing, and like I said, and I keep putting my hand on this. There's never been a time in our history to date in America over a 10-year window that an apartment building has not doubled in value. Okay, so if you bought something for $1 million today, in 10 years, it'll be at least or greater than $2 million.
Yeah,
And so
I believe that.
and so then it becomes just don't lose it. Meaning right? It's never an issue with real estate. Like you never lose in real estate unless you're forced. Think about this. You're never losing in real estate unless you're forced to sell properties. Because over time, like it's like very, very simple and it's predictable. The only time people lose in real estate, as we've seen, is when they get into positions where they have bad leverage, bad debt, bad financing. So that now allows them not to hold on to the property. So now they're forced to sell it or they can't pay the debt or something's happening because they either over leveraged it or they put bad debt in terms of interest rates and terms on it. And it happens, right? I mean, the financial crisis was a perfect example. I watched my dad go through a $60 million bankruptcy. Craziest thing I've ever seen in my life.
60 million,
Wild.
that's a lot.
Oh, it
So,
was off the chart.
so
It's
let,
the craziest thing I've
I,
ever seen in my
I
life.
have a question. So I know that we were talking about the breakdowns and when we get an investor to come in and how we break down the investment where, after everything is, during the monthly collection, 40% comes to us, but 60% goes to our investors based on how we set it up. My question to you is, um, should we put a percentage of that away for savings in regards to unexpected expenses that may come up where that we're not running around or trying to leverage money to take care of those things?
Yeah. So you have a reserve and replacement line item in your budget.
Okay.
That's all part of it. So it's already built in. So when I say the numbers you're talking about, that net operating income number, right? That number that goes
Mhm.
out to everybody, it's already including after you're paying for a reserve and replacement account. So
Gotcha.
it's already built into the expense budget of the property is a reserve and
Gotcha.
replacement line item. And that's for the stuff you're talking about. It's called the OSHIT number.
But
So
but
in
do we
case
continue?
things happen, that's right. You have a
Mhm.
line item there for what's called CapEx stuff, capital improvements,
Gotcha.
stuff that you can't plan for.
Gotcha. Okay, I
Once
didn't see
again,
that. Okay.
it's mitigating the risk. And that's why you have that line item because what'll happen is like anything, nothing really happens for a while. Everything's running great. And then all of a sudden, some washer dryers blow up, water heaters blow up. You have to replace part of the roof. I mean, that's just inevitable.
Mhm.
So you have that reserve and replacement account that's being accumulated into and deposited every single month. Every single month, money's going into that thing and it builds up. And then ultimately you'll have a big trust fund for when stuff like that happens.
Gotcha. Okay. Yeah. Yeah.
And
Well, okay. That's
and
good
then
to know.
also FYI, part of the closing cost, right? When I
Hmm.
was talking about, closing cost, there's a number in there that allows for working capital, like when you get started. And part of that working capital goes into that fund to kind of start it for that reserve fund.
Gotcha. Okay.
Yes. But
Yeah.
that's,
I think.
that's the
Yeah.
little nuanced details. Yeah.
Yeah. Like I said, it's very a lot of information I've heard before, but I think you provided a good amount of detail, and I love the approach. I think we had a 101 about a month ago,
Mhm.
before my travels, and I came back,
Yeah.
now I'm here. And so now I'm trying to, let me rephrase that. Now I'm going to execute on really trying to, go ahead and acquire my goal. My goal for 2026 is to at least acquire 2 units minimum. That
Okay.
is the minimum.
And are you in Illinois or is it?
No, no, I'm in Atlanta. I'm in
Okay.
Atlanta. Actually, I
Yeah.
was actually looking at, yeah, I was actually looking at a 24 unit. Um, and I put it through the spreadsheet, but I wanted to make sure that I'm doing everything right. So I think I set up some time with someone on your help desk to kind of walk me through the format to make
Yeah.
sure
And,
I'm not missing any
and
numbers.
yeah, great point. And so, part of that is like when you're reviewing deals, let's say you're in the community, you would submit that deal to us and our team. We will review it alongside you, reply to you, going through that deal analyzer, showing you where you're good, where you're bad, and tweaking
Mhm.
things in alignment. So that way, your numbers and you'll get smarter, right? What'll end up happening is after about two or three of those things, you're like, okay, I'm picking up on this, right? Because it's happening in real time with you and you're seeing the areas that you need to work on. Oh, I put a number here wrong, looked at this wrong. I didn't look at this. I need to put that there. And you'll immediately pick up on it. Then now your analyzation will be just like on point pretty quick.
So let me ask you a question. So I know a lot of times some of these apartment complexes are a bit overpriced. And what I do, and this is just me, and you can tell me if this is wrong or right. And how I identify if it's overpriced is I create a strike price, right? So what I do is I'll take um, the net operating costs, and I put a couple of zeros behind it to kind of leverage to see exactly if that net operating cost is going to be the equivalent of that. So in other words, if the net operating cost is at $272,000, my whole idea is not to go more than 2.6 million, right?
Gotcha.
And I'm trying to see if that is that for me, like if I'm just seeing numbers real quick, that's how I try to,
Yeah.
compute it. And I don't know
Um,
if that's a good habit or a bad habit, or if that's
I mean, I once again, I go back to the three metrics, and you don't need to go through a grand deal analyzer to do that. That's why we keep a simple one for the beginning, because you're really
or
looking at
some.
three metrics. Yeah, I mean, it's your cash on cash return, it's your IRR, and it's your equity multiple. Because I know that if those three things are in alignment and where they need to be, deal will produce cash flow. It'll pay you and your investors. You guys will all make money, and it'll be a cash flowing asset that has reasonably low leverage, and you'll sail off into the sunset. I mean, it's basic math, as Rudy was alluding to earlier today. It's just basic math. And so there's
Mhm.
not really, I mean, because when people say, oh, you can use the 1% rule or the 75% rule or this, and yeah, those are all kind of back of the napkin things to consider, but you can very easily get to the cash on cash IRR and equity multiple by plugging in some simple numbers into our deal analyzer. Because, like I said, we give you two different ones. We give everybody the simpler one, meaning 0 to 50 units as you get started. So that way you can easily see how numbers, right, interact with one another and get to the number you're looking at quickly. Then we have another deal analyzer when you're ready to go above 50 units and you're ready to play with big boys, right? That's a whole deal analyzer that's much different, right? But I don't want to give you that initially. Your head will pop off your shoulders. So I need to, we need to walk before we run here. But that would be
Yes,
the way that we start everyone. And then you get very, very good because that deal analyzer is perfect for anything under 50 units. Plug and play, and you'll get very good at
mhm,
looking at these things. And you could get through a deal within 5, 10 minutes
yeah,
using that thing.
okay.
Yeah.
So another question. I guess one of the things is as we start to acquire some of these complexes, apartment complexes, and of course some of them are C grade, some of them may be D, and possible some B. But I'm assuming there are, and this is of course down the road. As I have a model: crawl, run. That's my model,
Mhm.
right? So the whole thing about it is at the running stage, you know, it's how do you get into the whole development of partnering with someone on developing maybe 100 or 200 unit apartment complex? And have
Well,
you
I mean,
have
yeah,
you
that's a
done that yourself?
whole yeah, that I mean, that's a whole other ball game.
Mhm.
But yeah, you get into development. You're talking about ground up,
Yeah, but
taking
you ground up,
raw dirt and
but you just become an investor, not just. And I'm wondering,
uh,
have you yourself had the opportunity to do that, or
yeah.
thought about that as well?
Yeah, I mean, I knew a few folks in the space. I mean, so I come from a land development background. So we take raw dirt, we will entitle it. That's what they call that, entitling the land, getting it to permits, and then you can build it vertically, right? With capital. So that's just a whole other army, right? Because you're not taking an existing building. You're taking something from zero to hero just to get it to an existing building. Would focus on let's get you into your first 10 to 30. You can open up a lot of windows because you'll understand things at a different level once you get through that first deal. And as some of
Mm.
the people in the community were saying, like that first deal is always the hardest, and that's natural. But once you get over that hump, man, then the second one you're like, okay, I've been down this road before. Then the third one you're like, okay, heck with this 20 unit deal. Let's go for a 50, right? And that's what it's going to happen. It's going to happen.
Okay.
But that's the whole train ride. Is let's get into the first 10 to 30, then we can talk about another 10 to 30, and then ultimately I know where you're going to want to go. You're going to start seeing 30, 50, 60 unit deals in the Georgia area, and you're going to want to go after them.
Yeah, 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 definitely. Some in the Georgia. Well, I personally think that the Georgia areas prices are extremely overinflated.
Oh, they
A
are.
lot of
Yeah,
people.
you have to go to the
Yes.
outskirts for sure.
Yeah, in the
Yeah,
outskirts.
the
Yep.
main yeah, you're totally right. It is overpriced in certain areas, but you can go find some of those other deals on some of the what they call tertiary markets, all within
Mhm.
25 miles of the Atlanta area and some other pockets. Well, yeah,
Okay.
I look
All right.
forward to seeing you on here tomorrow, and we'll get through the closing process and those details as well as property management. We're going to be heading into all that tomorrow. So it'll be a great
Okay.
kind of half day to finish things up. Thank you very much, man.
Okay.
Appreciate it.